Hi everyone, welcome back to Investing Club. In this video, we're going to talk about Cumulus Media's Q2 earnings and what they reported that made their stock price jump 25%. A lot of good things happened for this company in the second quarter that really put them in a good position going forward. So be sure to watch through this whole video if you want to get a complete understanding of what the company looks like for the rest of 2020 and what I ultimately think this company is worth. That makes me confident in buying at these prices. Now, here are the highlights of the company's second quarter. They generated over $90 million in cash through selling off assets like some land in Maryland, and they also cut down their expenses by a huge amount that allowed them to generate $90 million in cash even with a loss in earnings. So through that, they ended the quarter with around $200 million in cash. And the second big thing that happened for this company was that they entered an agreement to sell their portfolio of radio towers for more than $210 million. And this is going to add to their liquidity, and ultimately this will go towards paying down the company's debt. So wow, they had radio towers that they sold for over $200 million. Who would have guessed?
But I think the largest asset they have that is being taken into account when the stock is being valued are they have a portfolio of 250 tower sites. Similar deals with other companies selling these tower sites the towers have been valued around $1 million per tower. So this is potentially $250 million in assets, in hidden assets that this company is sitting on that no one really knows about.
All right, so anyway, this is obviously a big deal for the company. That pretty much doubles the amount of cash they have on hand. And like I said in my original analysis of this company, these radio towers weren't reflected on the company's balance sheet. So I think now with this news coming out that this company just monetized it for over 200 million, a lot of new investors and even institutions are going to take a look at this company and say, oh, well, now with that extra 200 million, this company's actually in a better place than I thought. And I think that could potentially bring some new buyers to this company. So key highlights, like I said, they minimized their fixed costs by nearly 36 million in quarter two. And so for the total of 2020, they're expected to reduce their costs by 85 million, which is a huge amount. Now, another thing, they continue to see growth in their digital platform. So like I said in the past, I think one of the biggest drivers of growth for this company going forward will be their digital platform, their podcast network. And we've continued to see that grow even in quarter two, which is probably one of the worst quarters ever. They grew their cash balance up 91 million from quarter one, and they reduced their net debt by around 10%. And so I think that's such a huge deal, where even though this company reported a loss on earnings, they grew their cash balance and they paid down their debt by 10%. The CEO and management team have made it very clear that their number one priority right now is paying down as much debt as possible. And the fact that they were able to do that in extremely tough economic conditions shows how much of a priority that really is for them. So they generated 28 million of cash from operations, and they also got the 66 million from that sale of land in Maryland. And so on a cash flow basis, they were positive, and that's really what I want to see from this company. I'm not really concerned about the earnings. Like I've said about other companies, earnings have a lot of accounting items in there, and companies take losses for tax purposes, so that all plays into a company's earnings. But right now, what I'm focused on for all the companies I'm invested in is their cash flow, how much cash they're actually bringing in from their business. And so for this company, the earnings will come in time, but right now, as long as they're bringing in cash flow, that's really all I'm worried about for this company. And so balance sheet flexibility, no debt maturity until 2026. So that is a good thing for this company, even though they do still have a lot of debt. They have just under $1 billion of debt. None of it matures until 2026, which gives them plenty of time to figure out a plan. And with the aggressive reduction of debt they've been doing over the past few years, I don't think it'll be a problem for them to really deleverage this company to an appropriate level. So in the second quarter, company had revenue of 146 million, which was obviously a decrease from the year prior, a net loss of 36 million, and EBITDA of negative 6.4 million. Their same station net revenue decreased around 46% from the second quarter 2019. And so obviously this company saw huge losses compared to a quarter ago, where the majority of this company's revenue is from radio advertising. So obviously they didn't bring in much from ads in the second quarter, where they normally have things like they have the broadcasting rights to the March Madness tournament and PGA golf tours and other events that didn't happen this year. So it's no surprise to me that they lost money. But like I said, as long as they're positive from operating cash flow, for this year, that's really the only thing that matters for this company. So now let's jump over to the earnings call to see what insight the management gives us about how their business fared in the second quarter and what their projections are through the rest of the year. So one of the first things the CEO talks about is the profitable growth of their digital platform. it grew by around 3.6% in the quarter, and they had organic revenue growth of more than 25%. They had 95 million downloads in June, up 16% from May and 41% year over year, and they had 5 of the top 25 podcasts in the news category. So like I said, this company's been expanding into the podcast space. I think this is probably one of the biggest drivers of growth for the company. You see other companies like Spotify signing huge deals with people like Joe Rogan and Kim Kardashian, and the reason the company gives so much money to these people is because they know they're going to make it back through ads and other ways that they can monetize these podcasts. And so I think Cumulus is hopping on the trend. While they're not known for mainly being a podcast company, that is an increasingly growing part of the business. Now here they're talking about the sale of their radio towers, and the deal was at a 14.25 times multiple. So that's pretty good in my opinion. In my original analysis, I said that these could potentially be worth around 200 million. So getting, I don't know what this was, 213 million or something like that is a pretty good amount. And this reflects their effort to get value from their non-core assets. So this is obviously what the company's priority is right now. If you research the history of this company, back in the early 2000s, there was a different CEO that just took on a bunch of debt and went on a buying spree. They started buying a bunch of assets like land, like radio towers that weren't effectively used. So what happened was they took on a ton of debt and they had all these assets that weren't producing cash for them. And eventually in 2017 and 2018, they finally default and they couldn't afford to make the payment. So among the restructuring, this new CEO gets put in. And so what the new CEO is doing is saying, we're going to take all of these assets that the old management bought that aren't really doing anything for us, and we're going to sell them off. Instead of just keeping them on our books and bringing in a tiny amount of revenue, we're just going to sell them all off and use them to deleverage the company. And we're really going to make our focus on the main business, which is radio broadcasting and in the digital podcast network. So basically any asset that the company has that isn't part of those two things is going to be sold off, and the cash is going to be used to pay down debt. So another thing they talk about is the political ads. So this year is the presidential election, and historically that always means increased revenues for radio companies because the presidential candidates play a bunch of advertisements over the radios. And so in this quarter they did start to see an increase in political ads coming through, but they say the largest chunk of their political revenues is historically in the fourth quarter. So I think in that quarter the company has the potential to make some huge revenues. Where you see the type of advertising budgets that the Republican Party and Democrat Party have, a lot of that is going to flow towards radio and naturally towards Cumulus. So this paragraph talks about all the expense reductions they've been doing. So along with their variable costs that have been reduced, obviously since their operations weren't as strong, they've also reduced fixed costs by around 19 million. And these cost savings will continue for the company since their fixed costs, every quarter this company had to pay this $19 million. They've now cut that out. So every year, that's an annualized benefit of around 36 million for the company. Because of the CARES Act, they filed for around 2.5 million in tax refunds that were paid in 2019. So some free money, that's always a good thing. And so in my opinion, this is the biggest development of this company for the year. Over the first half of the year, their net debt decreased from over $1 billion to 884 million, a reduction of 124 million of debt. And I think this is such huge news for the company because back at the beginning of this year, this stock was trading at around $20 and we saw it fall all the way to $3. And why did that happen? The main reason the fall was so great was because investors saw the stock and saw all the debt it had, and so they thought there's no way that this company is going to make it through this, and the stock dropped like a rock. And I think now the narrative is starting to change to the point where investors can realize this company actually is able to pay off all their debt and they have enough liquidity, especially with the sale of their radio towers that not everyone knew about. I think through the second half of 2020, this is really going to change the narrative of the stock and will allow it to go much higher from where it is now. So here they talk about, again, that sale of the radio towers for 213 million. And the great thing about the sale is that they're able to write off a lot of the taxes from the gain that they're getting from that sale. Since they've had operating losses this year, that's able to shelter the profits they get from this sale. So that's a silver lining of the negative earnings this year, is that it'll allow them to keep more of the profits from that sale. So the transaction is expected to close in Q4. And like they said, the majority of this is going to pay down debt. So after everything, after the sale, after the taxes are paid, their net debt should be in a range of around 700 million. And that is a huge difference from over $1 billion that we saw at the beginning of this year. Again, I think this is going to change the narrative of this company from one that's drowning in debt to one that actually has an actionable plan to deleverage the company and become a stable company that just starts throwing off cash flow once that debt is reduced. And so they didn't have that many questions asked, but one of the questions that were asked were about the potential sports cancellations for the rest of the year and how that would affect the company. And so the biggest rights that this company has for the rest of the year is NCAA football and the NFL. And so like I said, part of the reason they had the loss this quarter was because March Madness didn't happen, and this company has always brought in a large amount of revenues from their sports broadcasting. So if college football and the NFL do go on as planned, this would definitely be a positive for the company. Right now, reports are NFL privately remains confident full season will be played. So as of now, good news for Cumulus. They have exclusive rights to NFL broadcasting, so that will help out the company a ton if they're able to bring in those revenues. So finally, let's take a look at what happened with the stock price today. It was up 25%, and right now the stock is sitting at just under $5 a share. My average cost for the stock is $3.47, and that is an average cost I'm very comfortable with. I think I first made the video about this stock back in April maybe, and so since then we saw the run up to over $8 and then it came back down. And so in the past couple of weeks I have been buying some more of this stock. I think in my opinion anything under $4 is a no-brainer. So that's where I picked up some more shares, and now we're going up again. Like I said, I don't know if this is going to happen right now, but I think the narrative of this company will change and some more investors and even institutions will be drawn back into this company, and that will push the stock price a lot higher. So that's it for the update on this company. I'm very pleased with their earnings results. Definitely turned out better than I expected with the cost reductions and with the sale of those radio towers. The company is definitely on the right track, and if they keep doing what they're doing, they keep paying down the debt and focus on growing the digital part of this business, I think it'll be no time before the stock is back up to that, again, that $15 to $18 range, which I think right now is fair value for the stock. So that's what I'm holding the stock for. I probably wouldn't sell anywhere under $15. Once it gets up to that $15 to $18 range, that's when I'd start thinking about taking some profits for this company. So that's it for this video. If you found it helpful, hit the like button. If you want to watch more, subscribe to the channel and hit the bell icon so you get notified whenever I upload a new video. And I hope to see you on the next video.